In 2008, one of the largest investment banks in the world collapsed almost overnight. That company was Lehman Brothers. It had survived wars, recessions, and nearly 160 years of financial history. But in just a few days, everything fell apart. Its bankruptcy triggered the worst financial crisis since the Great Depression. So how did one of the most powerful banks on Wall Street collapse so suddenly? This is the rise and catastrophic fall of Lehman Brothers. The story begins in 1844. A German immigrant named Henry Lehman opened a small store in Alabama. Soon his brothers, Emmanuel and Mayer, joined him. Together they formed a business that became known as Lehman Brothers. At first they weren't bankers, they traded cotton. Cotton was one of the most valuable commodities in America at the time, and the Lehman Brothers quickly realized that trading commodities could be even more profitable than selling goods. Over time, they moved into finance. By the late 1800s, Lehman Brothers had become a major investment firm, helping companies raise money by selling stocks and bonds. They helped finance the growth of American industry. By the early 1900s, Lehman Brothers was deeply involved in funding major corporations across the United States. Over the decades, the firm built a powerful reputation on Wall Street. It survived economic disasters like the Great Depression. It survived world wars. It survived market crashes. For more than a century, Lehman Brothers was considered one of the pillars of the global financial system. But everything changed in the early 2000s. In the early 2000s, the United States experienced a massive housing boom. Banks began lending money to millions of people so they could buy homes. But many of these loans were risky. Some borrowers had poor credit. Others couldn't really afford the mortgages they were taking on. Yet banks kept lending anyway. Why? Because those mortgages could be bundled together and sold as complex financial products. Investment banks like Lehman Brothers bought huge amounts of these mortgages. Then they turned them into something called mortgage-backed securities. These securities were sold to investors all over the world. At first, it seemed like an incredible business. Housing prices kept rising, investors kept buying, and profits exploded. Lehman Brothers became one of the biggest players in the mortgage market. The firm was making billions. But behind the scenes, the risk was growing rapidly. By 2006, cracks were beginning to appear. Housing prices stopped rising. Some homeowners started defaulting on their loans. When people stopped paying their mortgages, the securities tied to those mortgages began to lose value. This was a huge problem for banks like Lehman Brothers. The firm had invested tens of billions of dollars into mortgage-related assets. As the housing market weakened, those investments became increasingly dangerous. Yet Lehman continued doubling down. Instead of reducing risk, the company increased its exposure to the collapsing housing market. Executives believed the downturn was temporary. They thought housing prices would recover. But they were wrong. In 2007 and 2008, the housing market collapsed. Mortgage defaults surged. The value of mortgage-backed securities plummeted. Banks across the financial system began reporting massive losses. Some financial institutions failed. Others needed emergency bailouts. But the biggest danger was still ahead. By 2008, investors had begun to lose confidence in Lehman Brothers. People started asking a simple question: was Lehman holding billions in toxic assets? As panic spread through the markets, Lehman's stock price collapsed. The firm desperately tried to raise money. Executives searched for buyers. They looked for government help, but none of it worked. On September 15, 2008, the unimaginable happened. Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. The firm had more than $600 billion in assets. When Lehman collapsed, it sent shockwaves across the global financial system. Markets panicked. Stock prices plunged. Banks stopped trusting each other. Credit markets froze. What had started as a housing problem suddenly became a full-blown global financial crisis. Governments and central banks rushed to prevent the entire financial system from collapsing. The crisis that followed would reshape the global economy. The collapse of Lehman Brothers became the defining moment of the 2008 financial crisis. Millions of people lost their jobs. Homes were foreclosed. Entire economies fell into recession. The disaster exposed massive risks within the global financial system. In the years that followed, governments introduced new regulations designed to prevent banks from taking similar risks again. But the fall of Lehman Brothers remains one of the most dramatic financial collapses in history. A company that had survived for over 150 years was destroyed in just a few days. The story of Lehman Brothers is a reminder of how quickly even the most powerful institutions can collapse. When risk is ignored and confidence disappears, even giants can fall.